In this video, I'm going to share one of my investments where I earned over 146% returns in just 16 months. I'll also explain the reasons behind my investment decision and how you can value a company before investing. So make sure you watch till the end to learn not just how I achieved this 145% return, but also how you can apply a valuation-based investing approach in your own journey. I'm going to share one of my investments in Gokul Agro. I invested in Gokul Agro on 2nd February 2024 at around 121 rupees and sold it on 30th June 2025 at 298 rupees. But the most important part isn't the return, it's the process behind it. I want you to understand how I valued the company and what gave me the conviction to hold even when things got tough. Right after I invested, the stock fell by more than 20%, but because I had confidence in my valuation and analysis, I wasn't shaken by that short-term volatility. I held on to my investment, and that conviction made all the difference. Now let's see the discounted cash flow (DCF) valuation of Gokul Agro Resources, a company engaged in manufacturing and trading of edible and non-edible oils, castor oil derivatives, meals, cereals, spices, and oil seeds. When I first analyzed Gokul Agro, its EBITDA margin was around 3%, and I took a conservative approach, assuming that margins would remain constant with no improvement over time. For revenue, I assumed a 15% annual growth rate, reflecting consistent expansion without being overly optimistic. In the first year, I projected revenues of about 12,351 crores, which gradually increase each year, reaching nearly 45,622 crores by the terminal year. Since I assumed the EBITDA margin would remain at 3%, the cost of goods sold takes up nearly 97% of revenues, starting at 11,980 crores in year one and increasing in line with revenue growth. Depreciation begins at around 31 crores and grows slowly to 63 crores by the terminal year, reflecting the company's continuous investment in its productive assets. Subtracting COGS and depreciation from revenues gives us EBIT, earnings before interest and tax, which starts at 340 crores in the first year and rises to about 1,305 crores in the terminal year. After applying tax rate, the post-tax operating profit starts at 257 crores and increases to 986 crores. Because depreciation is a non-cash expense, I added it back to calculate actual cash generated from operations. Next, I deducted capital expenditure and changes in working capital, as both represent cash outflows necessary for growth. Capital spending starts at 160 crores and gradually scales up to around 159 crores in year 10. The change in working capital is minus 97 crores in year 1 and minus 113 crore in year 10. After adjusting for all these factors, I calculated the free cash flow to the firm. It starts at about 224 crores in year 1 and grows steadily to 1,083 crores by year 10. These free cash flows were then discounted back to present value at 11%, weighted average cost of capital to reflect the time value of money and investment risk. The present value of these cash flows ranges from 202 crores in year 1 to 351 crores in year 10. Beyond that, I calculated a terminal value which captures the company's value after the 10-year projection period, assuming stable, long-term growth. After projecting the free cash flows for Gokul Agro Resources Limited, over 10 years, the next step in my valuation was to estimate the present value of those future cash flows. The present value of free cash flows during the high growth phase, that is, the first 10 years of projection, came out to around 2,532 crores. This represents the cumulative value today of all the cash the company is expected to generate in that period, after accounting for taxes, reinvestment, and working capital changes. Beyond the high-growth phase, I assumed that Gokul Agro would enter a stable growth period, where the business grows at a steady, sustainable pace. To capture the company's value beyond the forecast horizon, I calculated a terminal value which reflects the firm's long-term cash-generating ability. The present value of this terminal value was estimated at 8,758 crores. When we combine the present value of cash flows during the high-growth phase and the terminal value, we get the enterprise value of the company. I then subtracted the market value of debt, which was around 484 crores, since debt holders have a prior claim on the company's assets. What remains after subtracting debt is the market value of equity, which came out to 10,805 crores. Additionally, Gokul Agro had around 445 crores in cash and cash equivalents, which needed to be added back. After including this, the total equity value of the company increased to approximately 11,250 crores. Finally, to determine the intrinsic value per share, I divided the total equity value by the number of outstanding shares, which was 14.7 crore shares. This gave me a value per share of about 765 rupees. The stock was trading around 121 per share. After completing my DCF valuation, I realized there was a significant gap between the market price and the intrinsic value of the company. My valuation suggested an intrinsic value of around 765 per share, which meant the stock was trading at a deep discount to its fair value. Seeing that large margin of safety, I decided to invest in Gokul Agro. Over time, the company's fundamentals remained stable, and my conviction in the valuation helped me stay invested despite short-term fluctuations. Eventually, I sold my holdings at around 300 per share, locking in a strong return. Even though my valuation indicated a much higher intrinsic value, I exited the position because I found another investment opportunity offering a better risk-reward profile and greater margin of safety. Interestingly, after I sold, Gokul Agro's share price went above 400 per share, but I have absolutely no regrets. For me, investing is not about catching the top, it's about making rational decisions based on valuation, risk, and opportunity cost. This video is for educational and informational purposes only. I am not a Securities and Exchange Board of India registered financial advisor, and nothing discussed here should be considered financial or investment advice. Please do your own research or consult a registered financial advisor before making any investment decisions.